In global capital markets, there are all sorts of proverbs to help investors navigate through the volatility. You may have heard phrases like "don't put all your eggs in one basket," or "only invest what you can afford to lose." While these are certainly nice little reminders, they do little in terms of depth and detailed explanation. That's where the barbell strategy comes in. New thinking, new finance. Welcome to the session on Introduction to Barbell Strategy, brought to you by Legend Finance Academy. The barbell investment strategy is basically a tale of two extremes in order to increase risk-adjusted returns on your investment portfolio. Invest 80 to 90% of your money in extremely safe instruments, and the rest in risky instruments with extreme upsides. The risky instruments could be trading in managed mutual funds, index funds, and momentum strategies. Before we dive into this theory, let's bring it to our normal life first. We are in a constant conflict of doing a meaningful job versus making more money. Most of us end up with jobs we hate just for more money. It's an unsolved riddle like the chicken and the egg problem. We do not know where our desires stand. Do we want more money, or do we want more job satisfaction? We do need to pay our bills and live a secured life. Because you do not want to be a starving artist, you have to play it safe. Go for the traditional career. Never take risks. But is there a way we can increase our overall job satisfaction? Yes, the barbell strategy. While we continue to work an ordinary job, we can also create something which can excite ourselves. Simply put, you must take full control of your own time. In order to survive, we all have to fulfill a baseline living standard, which translates to a baseline income stream. This is non-free time, and the rest, fortunately, is all yours. History is filled with examples of artists practicing this strategy. The great French poets Paul Claudel and Saint John Perse and the novelist Stendhal were all diplomats. So, don't worry about it and continue to work your day job. Take small risks on the side doing things you love. Be extremely safe on one side and explosive on the other. So, now that we understand the basics of the barbell strategy in the context of lifestyle, let's put this philosophy into the world of finance. The underlying logic of this strategy is akin to the 80-20 principle proposed by Pareto. 80% of the gains are achieved from 20% of investments. This approach is called a barbell because holdings are bunched on either end, with few investments in the middle. Much like a barbell in real life, the barbell strategy involves finding a perfect balance between assets to ensure you have the most efficient and profitable portfolio possible. On one end, you have investments with low risk and low reward potential. On the other, higher risk assets with a potentially higher reward. Because there are two sides of the portfolio, this strategy can be weighted numerous ways depending on your needs. To use an example from the traditional world of investing, a portfolio using this strategy could consist of 90% bonds with promised return on one side and 10% extremely risky stocks on the other. Remember, there is no middle ground here. Those mid-range stocks can often be mispriced for the risks involved. They have longish maturities, yet often their coupon is not a lot above T-bills. In this case, the maximum you can lose is the 10% invested in the diversified, speculative investments. The precise numbers of 90% and 10% are guidelines, not hard rules. If you feel like you have a higher tolerance for risk or otherwise can withstand some hits, then feel free to go for some extra risk. And vice versa, of course, if you prefer to play it safer. Just keep in mind the three key concepts. Protect yourself from total ruin. Avoid the unbalanced middle. Go for a few high-risk, high-reward bets. Why would someone want to use the barbell strategy then? Here are a few reasons you might want to consider. No one can predict the markets. That's right. Even those expert analysts and their fancy Fibonacci sequences, head and shoulder patterns, etc., are more or less guessing the future based on the past. Sometimes they are right, but sometimes, I would say for most of the time, they are absolutely wrong. Hence, it's more valuable if you spend time learning how to balance your portfolio as opposed to learning how to predict the future. I will propose here that because of the uncertainty in future prediction and the existence of black swan event, the best thing you can do is practicing barbell strategy. If you learn to design your portfolio in a specific way, then you can protect yourself during bad times and gain heavily during good times. For example, if you want exposure to the 10-year US Treasury, you could simply buy a 10-year Treasury bond. That's known as a bullet strategy. To replicate owning a 10-year bond with a barbell strategy, you'd buy an equal amount of 5-year and 15-year maturities that blend together to get an average maturity of 10 years. This can reduce investment risk because short-term and long-term bonds tend to be negatively correlated. Sometimes short-term bonds perform better when long-term bonds underperform and vice versa. One other reason why you should pursue the barbell strategy is that you can reinvest the proceeds of the shorter-term securities, possibly at a higher rate, giving yourself a chance to receive higher yields than if you would have simply bought a 10-year bond. Additionally, if you need liquidity, the short-term bonds will mature faster, giving them flexibility. A flattening yield curve benefits a barbell strategy because the yields on short-term bonds are higher than long-term bonds, so investors may be able to get higher yields when their shorter-dated bonds mature. Things might have become increasingly puzzling now. But don't worry. If you guys are interested in what the heck is yield curve or anything else, let me know in the comment down below, and I'll talk about this in our next video. I believe the strategy has huge application on basically every aspect of our life. You can deploy it in your overall health and fitness, or even among personal relationship. Ultimately, barbell strategy is all about providing for the worst and let the best take care of itself. The focus must be to provide for the larger infrequent losses, but always keep in mind, asset allocation and diversification do not eliminate the risk of experiencing investment losses. Okay, that's all for today's video. What's your thoughts about this strategy? Or do you have any better strategy on investing, time management, or whatever? Share with us down below. If you found this video interesting, consider getting subscribed. Thank you very much for watching, and I hope to see you in the next video.